Welcome to Money Decoded, where we break down personal finance, one concept at a time. Let's decode today's topic. You've been lied to about credit. Not intentionally, maybe, but the advice you've heard from well-meaning friends, family members, even some financial advisors, a lot of it is wrong. And believing these myths is costing you money. Real money. We're talking thousands of dollars over your lifetime from mistakes that could be avoided with the right information. Today, we're breaking down 7 credit myths that are still costing people money. Myth 1. Carrying a balance builds credit. Myth 2. Checking your score hurts it. Myth 3. Closing cards helps your credit. And 4 more that might be draining your wallet right now. Let's break them down. Before we begin, a quick disclaimer. This content is for educational and informational purposes only and should not be considered financial advice. Please consult with a qualified financial advisor before making any financial decisions. Let's start with the biggest myth, the one that costs people the most money every single year. Myth number 1. Carrying a small balance on your credit card helps your credit score. This is probably the most widespread credit myth, and it's completely false. People believe that if they carry a small balance and make regular payments, it shows the credit bureaus that they're actively using credit responsibly. Here's the truth. Carrying a balance does nothing for your credit score. Absolutely nothing. What matters is that you use the card and pay it off. The credit bureaus don't care if you carry a balance month to month. They care about your payment history and your utilization ratio. In fact, carrying a balance hurts you in 2 ways. First, you're paying interest for no reason. If your card has a 20% interest rate and you carry a $500 balance thinking it helps your score, you're paying about $100 a year in interest. For zero benefit. Second, carrying a balance actually increases your utilization ratio, which can lower your score. If you have a $5,000 credit limit and you're carrying a $500 balance, that's 10% utilization. If you paid it off completely, that's 0% utilization. Lower is better for your score. The right way to build credit. Use your card for purchases, pay the statement balance in full every month before the due date. Your payment history shows you're responsible. Your utilization stays low, your score goes up, and you pay zero interest. Myth number 2. Checking your credit score hurts your credit. This myth stops people from monitoring their own credit, which is a huge mistake. Here's what's actually true. When you check your own credit score, that's called a soft inquiry. Soft inquiries do not affect your credit score at all. Zero impact. What does hurt your score is a hard inquiry. A hard inquiry happens when you apply for credit and a lender checks your score. Each hard inquiry can drop your score by about 5 points. But you checking your own score? That's soft. No damage. You should be checking your credit score regularly. At least once a month. Many credit card companies offer free credit score monitoring. Apps like Credit Karma are free. You can check as many times as you want. It will never hurt your score. Not checking your score is dangerous. You might have errors on your report. You might have fraudulent accounts you don't know about. You might not realize your score dropped because of a missed payment. Check your score often. Myth number 3. Closing old credit cards helps your credit score. People think that if they have credit cards they don't use, closing them will clean up their credit report and improve their score. This is backwards. Closing old cards hurts your score. Closing an old credit card damages your score in 2 ways. First, it reduces your available credit, which increases your utilization ratio. If you have 2 cards with $10,000 limits each and you're carrying $2,000 in debt, that's 10% utilization across $20,000 of available credit. If you close 1 card, now you have $10,000 of available credit and $2,000 of debt. That's 20% utilization. Your utilization just doubled, and your score drops immediately. Second, closing your oldest card can reduce the average age of your credit accounts. Length of credit history is 15% of your score. If your oldest card is 10 years old and your other cards are 2 years old, your average account age is helping you. Close that 10-year-old card, and your average age drops significantly. Your score drops with it. The right move. Keep old cards open, even if you rarely use them. Use them once every 6 months for a small purchase, pay it off immediately, and let them sit in your drawer. That old card is helping your score just by existing. Myth number 4. You need to be in debt to build credit. People believe that if you don't have a car loan, a mortgage, or credit card debt, you can't build a good credit score. This is false and dangerous because it encourages people to take on debt they don't need. You can build excellent credit without ever paying a penny of interest. Here's how. Get a credit card. Use it for normal purchases like gas and groceries. Pay the statement balance in full every month. That's it. You're using credit, you're paying on time, and you're carrying no debt. Credit scoring models don't reward you for paying interest. They reward you for managing credit responsibly. Paying in full every month is the definition of responsible credit management. You can have an 800 credit score with zero debt. Don't take out a car loan when you could pay cash just to build credit. You're paying thousands in interest for a marginal credit score benefit. Myth number 5. Income affects your credit score. People think that making more money will improve their credit score, or that losing a job will hurt it. Your income is not a factor in your credit score calculation. Not at all. Your credit score is based on 5 factors: payment history, credit utilization, length of credit history, credit mix, and new credit. Income is not on that list. You can make $30,000 a year and have an 800 credit score. You can make $300,000 a year and have a 500 credit score. Now, income does matter when you apply for credit. Lenders look at your income to determine how much credit to extend to you. But the credit bureaus don't track your income, and it doesn't affect your score. Your score doesn't know you lost your job. What matters is whether you continue making your payments on time. Myth number 6. Paying off a collection removes it from your credit report. If you have a debt in collections and you pay it off, many people believe it will disappear from their credit report. It doesn't work that way. The collection account stays on your report for 7 years from the date of first delinquency. Paying it off changes the status from unpaid to paid, which is better than leaving it unpaid. But it's still a collection on your report, and it still hurts your score. Some collection agencies will agree to delete the collection in exchange for payment. This is called pay for delete. It's not guaranteed, but it's worth asking for. Get any agreement in writing before you pay. Myth number 7. All credit scores are the same. When you check your credit score on Credit Karma, you might see 730. When you apply for a mortgage, the lender might see 710. You didn't do anything wrong. You just have multiple credit scores. There are different scoring models. FICO has multiple versions. Vantage Score is another model. Each credit bureau might have slightly different information about you. So you have dozens of scores, depending on which model and which bureau is being used. The important thing is the trend. If all your scores are going up, you're doing well. If they're all going down, investigate. Focus on the direction and the overall range. Here's the bottom line. Stop carrying balances to build credit. You're just paying interest for nothing. Check your score as often as you want. It's a soft inquiry and does zero damage. Don't close old cards unless there's a fee you can't justify. You don't need debt to build credit. Income doesn't affect your score. Paying collections doesn't erase them from your report. And you have multiple scores, not just one. Understand what's actually true, act on accurate information, and you'll save money while building better credit. These myths cost Americans billions every year. Set up autopay for the full statement balance right now. Takes 2 minutes. That one action protects you from the most expensive myth on this list. Next time on Money Decoded, we're breaking down exactly how to check your credit score for free without hurting it. I'll show you 3 legal ways to monitor your credit, what to look for when you check, and how often you should be doing it. If you're not monitoring your credit regularly, you're flying blind. Don't miss it. And that's how this works. If this helped you understand money better, subscribe for weekly financial deep dives. Thanks for watching.